of course, once we're done with the loan process, we get something called the clear to close. After we review all the documents and we get all the conditions, and the approval process is 100% complete, we get something that's called the clear to close, and we are ready to close. That's when I tell my clients, it's not over till it's over, but you're almost there. Once you sign those docs, then it's done. So closing time, of course, we're going to work with the escrow officer from the title to get that date down and make sure that it works for everybody. But you all know that because you do this all the time on all of your closings. So I'm going to go ahead and skip over. So investors, do you ever wonder where we get our money as a bank, as a lender? Here's where we get it from. So our government will give the money to Fannie Mae, Freddie, Ginnie, and Fannie Mae and Freddie Mac are conventional lenders. Ginnie Mae is FHA. They're all of the government-backed loans. But let's say our government gives the money to all of them at like a 5%. And then they give it to us direct lenders at a 6%. And then we give it to the public, to the client at 7%. And that's how we actually get our money and our funds. So we have lots of investors that we have like 40 different investors that they give us lines of credit. And because we're a direct lender, we have our own underwriting, our own processing. They actually can underwrite a file for a VA loan and say, okay, I'm going to go ahead and approve this loan. And we don't have to send it into VA for them to look at before we actually have the approval. We get to do it ourselves. But as long as we follow their guidelines, then we are good to go. So here's what happens after we close. We close your loan or their loan. And then a couple of months later, we're going to sell by bulk. Like there's a big bulk, millions of dollars of loans that we're going to sell to Freddie Mac. And as long as we use their guidelines and follow their guidelines to approve these loans, they will buy those loans in bulk. And that's when you hear sometimes that your servicing has changed. Like, oh, someone else is now collecting the money on my payment. And it's not because they make payments on time. It could be that, they did make all of their payments on time, and that's what they were looking for, those bulk of loans to be purchased by Freddie Mac or Fannie Mae or Ginnie Mae. And then once they do that, they replenish our lines of credit and we get to fund more loans. And that's how we continue to make money, and it goes round and round and round, and we never run out of money. So here's the loan products. I know that Jennifer's been doing some, what are you calling it right now? It's private lending, really. It's creative financing, but we have like non-QM loans. And what a non-QM loan is, I believe you're going to hear more and more about this type of loan. Well, let me tell you, back in the day when I started doing loans, we used to call them subprime loans. So they were like your non-traditional loans, but I have a slide in here that it's going to tell you exactly what they are. But non-QM loans are basically loans that don't have to follow the same rules as a conventional or an FHA or USDA loan, or a VA loan. So a VA loan, obviously, is for a veteran, except for when someone is assuming a VA loan, you do not have to be a veteran. Let's see if I open a can of worms up on that one. Nope. Okay. Yeah.
No, actually, you could also, did you know clients could also assume, what is it, a VA loan and is it the FHA loans too?
Yeah. Yeah, they can.
Those are the two ones that they can assume, right?
No, they can assume conventional as well.
They just have to go through that process of getting approved by the lender.
Yeah. First is, so veterans, I know, I just did an assumable loan. So here's the way this works. On a VA loan, if you wanted to assume, if your borrower wanted to assume somebody's VA loan that is already in existence, let's say they have a 3%, what happens is the new lender is no longer involved because we're not doing that loan. They're assuming the existing loan, which owner of that loan has to call their lender and say, hey, I want to allow someone to assume my loan. And then they will decide if they're willing to allow you to do it or not. Even though VA said also up to the lender that's carrying the loan to say, yes, we're willing to allow someone else to assume your loan. And on a VA loan, you don't have to be another veteran. It could just be anybody. But nobody's getting paid on that loan. Just so you guys know, like if I was your lender and I had your borrower pre-approved and they decided that they were going to try and assume a veteran's loan, then I wouldn't get paid on it. But they have to work directly with the owner and the existing lender. But just on that note, I get, because I guess it shows up somewhere on MLS if I was a lender that helps someone assume a loan, because I started getting a lot of calls after I did the first one. And I just said, look, you know what? Like, I don't have to get paid on everything. If I can guide you, help you through this process and tell you what to do and what to expect, I'll be more than happy to do it. So a few of you guys have called me and asked me about that. And so I've kind of guided you through that just to see if you can get that VA loan assumed. Because it is a really good deal for the borrower. You guys will still get paid on it, because you're still doing a purchase. It's still a transaction, but the lender won't.
So even that VA lender that's working with the new buyer to help it get assumed or whatever, that lender doesn't get paid for all that extra work as well.
No, they do not.
Okay, so then it really is like, oh, hey, can you do me this favor? I'm trying to sell my property. Can you help me get this buyer assume my loan? And then it's like
Yes,
them willing to put in the work or not.
that's right. I mean, because
Oh, wow.
let's just say it's I'm going to use Bank of America, and they have that VA loan. So Bank of America would have to say, all right, let me go ahead and take a look at this new buyer that wants to assume this loan. And they would have to do an application with them. It's everything that you normally do, except for nobody's getting paid out on it. The bank is doing all of the work to pre-approve someone just to take over an existing loan. So it's not a new loan anymore. So they're not even charging like origination fees, nothing. They're just
I see.
swapping them out. Yeah.
So a big gift basket would probably help.
A very nice one. Yeah. I don't know what the limits are for realtors. You guys have a certain dollar amount that you can do, right?
Uh,
Gifts.
I think we're allowed to gift like lenders, aren't we? Uh,
I think there's a limit, and
or
unless,
like,
yeah, otherwise it's considered a kickback.
oh yeah,
Nobody likes that word.
I have to look back on the rules on that one.
Yeah. But anyway, so these are all of the different types of loans that we have. Between a conventional loan and an FHA loan. And it's going to be pretty brief, but it's going to be right here. So what's a conventional definition? A conventional loan is any mortgage not guaranteed or insured by the federal government. What will the interest rate be? Well, the interest rate for your home loan will be determined by the type of loan program that you qualify for and your credit score. So it could be a jumbo loan, conventional loan. It could just be, a refi or a purchase. All of that has something to do with what your interest rate will be, your credit score, and how much money you're putting down. What are the conventional loan down payment requirements? You would not believe all the questions I get on this. Everybody thinks that you have to have 20% down to get a conventional loan, and you don't. We percent down depending on your income bracket. So standard debt to income ratios are 28 over 36. And let me explain what that is. When we're looking at your debt ratio, that number, the 28, that represents 28% of your income that would go towards just your debt. So, sorry, just your mortgage, just your mortgage. So if you made $10,000 a month and they're saying they're only going to allow 28% of your income to go towards your mortgage, that means the maximum mortgage payment, including HOA, would be $2,800. Now, the other part represents the 36% represents all of your debt and your mortgage. So they're saying ideally they don't like to see your debt ratio be higher than 36%. That would be out of $10,000 a month, $3,600 to cover your mortgage, your car payment, your student loans, credit card debt. And I know that's a really small number, but that's how when we go through like Fannie Mae and Freddie Mac, and we're using their automated system to get these loans approved, those are like the debt ratios that it's coming at us. But there's always like different extenuating circumstances. Like I get them approved as high as like 43% and 50% on the back. It just depends on your borrower and their big picture. That's what it says with compensating factors. The credit history is really important on a conventional loan because it is private. They're not backed by our government loans. Then they're going to be a little bit more strict when it comes to what kind of credit scores they want to see, how long you've been on your job. I know this slide says that a FICO score of 620 and above is very helpful in obtaining an approval. Well, 620 is not very high, and sometimes we really struggle getting them approved. But you get some approved with the 620 credit score, especially if they're putting 15, 20, 30% down. Sometimes we get it approved. But ideally, on a conventional loan, what we like to see is credit scores of 680, 700, and above to be able to offer you the best interest rates, the best types of programs. And what types of property are eligible? While conventional mortgage guidelines allow you to purchase warrantable condos, planned unit developments, modular homes, manufactured homes, and 1 to 4 family residents, conventional loans can be used to finance primary residence, second homes, and investment properties. So yes, we can do investment properties as low as like 10% down. It just depends on your criteria. And then can I get a conventional mortgage loan after bankruptcy? The answer is yes. So if you have been discharged from a Chapter 7 bankruptcy for 4 years or more, you would be eligible to get a conventional loan. If you have had a Chapter 13 bankruptcy, it must be documented that your credit reputation has been reestablished for at least 2 years to be eligible for conventional loan. And what that means is, okay, you did a Chapter 13, which is basically reorganizing your debt. You could still be in that Chapter 13, but now you've reestablished, like you have a car loan that you've been making payments on time, credit card, all of those things for the last 2 years that they've been on time. We could still go ahead and do a conventional loan for you and get you approved. We just have to have the trustee's office tell us that it's okay to do that. They have to give us permission.